All right, so let's take a look. This is the second video for this exercise, applying the accounting equation to determine missing data. And this is a fairly challenging uh, little exercise that we have here. In a previous video, we solved for missing revenues, and we have now you probably have to watch the video, otherwise these numbers may not mean a whole lot to you as far as how we got to the answer. And then in part two, the second part of the first video, we solved for ending liabilities. So now we've got columns 3 and 4 to go, and we have to solve for any common stock that was issued during the year in this one. And then later we're going to solve for beginning assets. But first things first, um, we're going to solve for C, which is how much common stock was issued. All right. So if we think about this, it's not too terribly challenging. We can see here, look, some of you might be able to just eyeball this and figure it out. And if you can, that's great. But if I'm going to go kind of step by step and kind of arrange my thoughts. So we have beginning equity of $9,000. We have $28,000 in assets, and we have $19,000 in liabilities. Okay, so that's going to give me, I'm just going to write down 9,000 E. That's going to give me $9,000 in beginning equity. Now I can see right here that my ending equity is 19,000. So I'm going to have some increases in equity, and the question is, of course, how much of that equity is attributed to common stock. So, there are two components of equity, and one is retained earnings, in other words, net income that is not paid out in dividends and flows as a result to the balance sheet. So right here, we have our revenues of 18,000 and our expenses of 11,000. So we need to subtract the 11 from the 18, and we're going to come up with, squeeze this in here, that says NI, $7,000 of net income. Okay, and that gets us to a figure of 16,000. Okay, however, I didn't retain all of that 7,000. Notice that I paid out $1,000 in dividends. So I'm going to subtract $1,000 in dividends. And so we're showing now that we're at 15,000. Well, we have accounted for everything on the page, kind of. We already acknowledged that ending equity was 19,000, and we have looked at the net income minus dividends portion of it. So we could basically say that 9,000 plus 6,000 in retained earnings is 15,000. How did I get the 6,000? Again, 7,000 net income minus the $1,000 in dividends gives us a $6,000 addition to net income. That gets us to 15,000. But if we take 15,000 in ending liabilities from 34,000 beginning assets, this is 19,000. And so I'm just going to jot this down here. 19,000 minus the 15,000 gives us 4,000. And that is in fact going to be our answer for C. Now again, you might just look at this and say, okay, well, 9,000, 19,000, I need a difference of 10. So there's 7,000 of it right here. Wait a minute, I got to reduce that by 1,000 to 6. So to get from 6 to 10, I got to add 4. Okay, that's great. If you can do that, that's lovely. Not everybody can, and so I kind of draw this out a little bit, maybe more than what you would like, so that I can account for everybody. And then in column D, we're solving for beginning assets. So what I would do in this particular case is I would start here, mostly because I have all of the ingredients. Okay. We can see that we have issued $3,500 in common stock throughout the year. Common stock is our common stock issued is additional owner investment into the company. And then we can also calculate net income, revenues of 24,000 minus expenses of 17,000 gives us $7,000. So now we're at 10,500. And notice that we paid some dividends here of 6,500. So just like we did in the previous example with the smaller figure, give me one second, I'm going to label that 7,000 as net income. $6,500 in dividends, we're going to subtract those out. Okay, and so we have a $4,000 increase in equity. Okay, $4,000 increase in equity at the end of the year. All right, so let's look right here, and we know that equity at the end of the year is 21,000. 21,000. So if we think about that, so let's just write this down. 40,000 minus 19,000 gives us 21,000. Is that, make sure that says 21,000 and not 210,000. So 21,000. So if ending equity, and write a little bit more now that I'm on the last one. If ending equity is 21,000 and equity went up by 4,000 during the year, then that must mean that beginning equity was 17,000, right? And so if that's true, if beginning equity was 17,000 and liabilities are 9,000, then it stands to reason that our answer here must be 26,000. $26,000 in assets equals liabilities of 9,000 plus, let's see, we never did get this. I'll just write this down real quick. 21,000. So this is the 21,000 ending equity minus the $4,000 increase in equity gives us 17,000. So I'll go over that again. Assets of 26,000 equals liabilities of 9,000 plus beginning equity of 17,000, because remember, we're solving for beginning assets. So that's how we would get there. We actually had liabilities provided to us, and then we said, okay, well, if ending equity is 21, we had a $4,000 increase in equity. That must mean that beginning equity is 17,000. Therefore, we can say, and again, I've got a little bit more room now, so we can say 26,000 in assets equals 9,000 in beginning liabilities plus 17,000 in beginning equity. And we have completed this exercise.